Over the past 2 years, most people have focused on the sharp rise in gold prices. However, if we look more closely at global financial markets over the last 6 months, gold has not been the real centerpiece. Nor has it been equities. Instead, the asset that has quietly taken center stage is silver, a metal long viewed as gold's lesser counterpart. Burdened by years of stagnant and suppressed pricing. Beginning in the spring and summer of 2025, silver prices consistently broke above the $30 per ounce level, reaching their highest point in more than a decade. Within a single year, silver recorded gains of approximately 190%. By comparison, during the same period, gold rose by roughly 70%. Since July 2025, international silver prices have continued to establish new multi-year highs, surprising many market participants with the strength and persistence of the rally. As with any major price movement, the market has offered multiple explanations. Yet at its core, this surge has been driven by one fundamental dynamic: short covering pressure. To understand what short covering means, we first need to revisit one of the most basic concepts in financial markets: the distinction between spot markets and futures markets. A simple real-world analogy is real estate. Buying an existing home is a spot transaction. Payment and ownership are exchanged at the same time. In contrast, purchasing a property under construction involves paying up front but receiving only a contract, with delivery taking place years later once the project is completed. That contract represents a forward commitment, a structure similar to futures contracts in financial markets. This is precisely why markets distinguish between spot assets and forward or futures-based assets. However, the real influence of futures markets extends far beyond simple trading. Before futures contracts existed, if you believed the price of a commodity, say, garlic, was about to rise sharply, the only way to profit was to physically buy and store massive quantities in advance. That meant sourcing the product, arranging transportation, managing storage conditions, and eventually handling distribution when it came time to sell. Every step introduced additional costs and operational risks, steadily eroding the potential profit. This is the inherent limitation of spot market transactions. Futures markets operate very differently. A futures contract functions much like a digital claim ticket. Before physical delivery ever takes place, that contract can change hands countless times, while the underlying commodity itself remains completely untouched by the trading process. This leads us to the most critical element of futures markets: the futures contract itself. In theory, futures trading can become detached from the actual quantity of physical goods available. Contracts can be bought and sold in volumes that vastly exceed real-world supply. This structural feature has, in certain historical cases, contributed to severe market dislocations, including well-known incidents in government bond futures markets. That story deserves a deeper discussion on another occasion. For now, what matters is this. In today's mature global commodity markets, there is theoretically no hard ceiling on the number of futures contracts that can exist. Unlike stocks, where the number of shares sold is limited by how many are actually issued, futures contracts operate under a very different mechanism. As long as there is a willing buyer and a willing seller, the exchange can match the trade. This allows new futures contracts to be created continuously. In other words, futures trading is driven almost entirely by the intentions and expectations of market participants, rather than by the physical existence of the underlying commodity itself. This is the defining characteristic of futures markets. A futures contract is simply an agreement between two parties, not a direct representation of physical goods. So how does this relate to the recent surge in silver prices? Let's walk through a simplified example. Imagine you are a merchant who believes that 3 months from now, the price of a cup of milk tea will fall from its current level of around $3 per cup to just 75 cents. To profit from this expectation, you begin selling milk tea redemption vouchers at $1.50 per cup, with the condition that holders can redeem them for 1 cup of milk tea on a fixed date 3 months later. From the buyer's perspective, the consumer, this looks like a great deal. They are paying roughly half the current market price. From your perspective, this also seems profitable. If the price does fall to 75 cents as expected, each voucher would generate a net profit of 75 cents per cup. Motivated by potential gains, you begin issuing and selling a large volume of these redemption rights into the market. And then, something unexpected happens. A buyer enters the market, extremely well capitalized and operating quietly in the background. For clarity, we'll refer to this participant as the long side. This buyer soon realizes something critical. The total number of redemption vouchers you have issued far exceeds the maximum milk tea production capacity of all stores nationwide on the delivery date. In response, the buyer takes two decisive steps. First, they continue accumulating vouchers. They quietly purchase a large portion of the outstanding contracts and hold them tightly. Second, they secure the spot supply. Through intermediaries, their team places advance orders and deposits across the country, effectively reserving the entire milk tea production capacity for that specific delivery day. 3 months pass. According to the contract terms, you are now obligated to deliver the milk tea to voucher holders. But when you approach the stores, you receive the same response everywhere. All production for that day has already been fully allocated. At this point, you are facing a spot supply shortage. Unable to obtain physical milk tea for delivery, you are exposed to substantial contractual penalties and reputational damage. With no viable alternatives, you are forced to turn to the very buyer who now controls both a large share of the vouchers and a significant portion of the available spot supply. Their response is simple. If you want milk tea for delivery, you can buy it from us. At $15 per cup. From that moment on, you are effectively caught in a downward spiral. To avoid breaching your contracts, you have no choice but to absorb the losses, buying milk tea that should be worth around $3 per cup at prices of $15 instead. But as the delivery date approaches, the counterparty becomes increasingly aggressive. Prices are revised upward repeatedly. $15 becomes $18. $18 becomes $30. What you are experiencing is known as a delivery squeeze. A delivery squeeze is one of the most intense and unforgiving dynamics in futures markets. At this stage, control rests almost entirely with the long side. They understand that the physical delivery deadline is approaching by the second. With that leverage, they continue accumulating supply, driving prices higher, and forcing the short side to cover at progressively worse levels, until financial resources and market credibility are severely strained. In real-world capital markets, this process unfolds far faster and with far greater intensity. According to data from international futures markets, financial leverage in futures trading typically ranges from 8 to as high as 33 times the original capital. This effectively means that, in futures markets, more than 90% of the capital involved often consists of borrowed funds. Under such conditions, prices do not need to move dramatically. Even a fluctuation of just a few percentage points can place investors under immediate pressure to close their positions. Once available margin becomes insufficient, or price movements continue in an unfavorable direction, trading systems automatically trigger forced position closures, commonly known as liquidations. It is important to understand the purpose of this mechanism. Automatic liquidation exists to protect capital providers and clearing institutions, not to minimize losses for individual traders. As a result, the system does not negotiate. It does not attempt to find the most favorable execution price. Instead, it executes orders directly at prevailing market prices, prioritizing speed over efficiency, buying back exposure as quickly as possible. Now imagine that the previously mentioned buyer controls nearly all available spot supply. If only a handful of units are released into the market, say, 2 cups of milk tea, each offered at $60 per cup. What happens next? The automated liquidation algorithms will still absorb those prices without hesitation. Because trading volume is extremely limited, the market price at that moment becomes highly distorted, driven not by broad participation, but by severe scarcity of supply. In such scenarios, price discovery temporarily breaks down, reflecting structural stress rather than fundamental value. If they quote $30, the market price is $30. If they quote $1.500, the market price becomes $1.500. At this point, some may ask, how can anyone buy at such irrational prices? The answer is unchanged. A large amount of capital is being forced to close positions. Driven by automated systems, that capital has no choice but to buy, even at record high prices. Now consider the final step. In this market, there are hundreds or even thousands of participants like you, who previously sold massive amounts of milk tea vouchers. Each time another seller is forced to liquidate, more capital is pushed from the selling side to the buying side, purchasing spot milk tea regardless of price. This further worsens spot supply shortages and pushes prices even higher. Cycle after cycle, higher prices then trigger more forced liquidations, which drive prices up again. This is known as a liquidation spiral in futures markets. A short squeeze works the same way. As short sellers are forced to buy back positions, their capital fuels further price increases, placing pressure on additional short positions. Repeated enough times, prices in the short to medium term tend to move in one direction, rising rapidly and aggressively. The recent surge in silver prices follows the same logic as this milk tea example. The starting point is physical supply scarcity, leading to a form of supply lock-in. Silver faces a natural supply constraint. Although silver is a mined metal, it differs from iron ore or gold, which are often extracted from dedicated mines. In most cases, silver is produced as a byproduct of lead, zinc, and copper mining, rather than being mined independently. As a result, silver output is tightly constrained. This is why, even as demand from sectors such as solar energy and electric vehicles has surged, physical silver supply has been unable to keep pace. Because demand for lead, zinc, and copper has not increased at the same rate. If production of primary metals does not accelerate, silver, as a byproduct, has no practical way to scale output rapidly. There is a common claim online that higher refining capacity alone could flood the market with byproduct silver, eliminating any foundation for price increases. In reality, global lead smelting accounts for only about 35% of total silver supply, making it the largest single source, but still highly inefficient. On average, 1 metric ton of lead yields only around 30 grams of silver. If silver demand were to double and prices were to double as a result, while demand for lead remained largely unchanged, producers would still lack sufficient incentive to double mining output. Primary metal production cannot be expanded simply because silver prices rise. Silver represents too small a fraction of lead ore to justify that decision. From an economic standpoint, it would mean sacrificing the main revenue driver for a marginal byproduct. As for inventories, physical silver stocks are effectively absorbed by demand every year. Global annual silver production is approximately 26.000 metric tons. Industrial use and jewelry consumption alone account for nearly all of that supply. From this, two key characteristics of silver become clear. First, unlike many other metals, higher silver prices do not meaningfully increase silver output, and lower prices do not significantly reduce supply. As a result, silver's supply and demand are frequently out of sync. Second, global physical silver inventories remain consistently low. Spot supply elasticity, at least in the short term, is even tighter than that of gold. This creates a critical vulnerability. If an unexpected event suddenly tightens spot silver availability, silver futures markets become highly susceptible to explosive short squeeze dynamics. As physical, milk tea, meaning real silver, becomes scarcer, while milk tea vouchers, futures contracts, continue to expand in number, some market participants inevitably lose the ability to make physical delivery. So the question becomes, what happens next? In July 2025, the cost of borrowing spot silver in London surged from near 0% to 7%. This signaled a simple reality. Some market participants could no longer source physical silver and were forced to borrow it temporarily, hoping to return it once inventory conditions improved. But this was only the beginning. By late August, spot silver lease rates spiked to an all-time high of 39%. At that point, short sellers were unable to secure physical silver at all. Much like in the milk tea example, where participants were forced to pay extreme prices just to obtain spot supply. At the same time, another factor entered the picture. In April of the previous year, U.S. President Donald Trump stated that silver could be considered for inclusion in a category of restricted trade commodities, potentially subject to higher import and export tariffs. As a result, large amounts of global silver inventories were urgently shipped to the United States as a precautionary move. The region most affected by this shift was London, the world's primary hub for precious metals trading. This helps explain why the latest spot silver shortage first became visible in London. In other words, some market participants identified the opportunity early, during the uncertainty surrounding trade policy, and positioned themselves against silver short positions. From a theoretical standpoint, this policy signal should have been a short-term political factor, not a driver of prolonged market stress. However, as discussed earlier, silver is structurally different from most base commodities. Its supply is heavily dependent on byproduct mining, and tight spot availability has been a long-standing issue. According to the World Silver Survey 2025, the silver market has remained in deficit for 5 consecutive years. By the end of 2025, the cumulative supply shortfall had reached nearly 900 million ounces. In 2025 alone, global solar power installation expanded rapidly. The photovoltaic sector by itself accounted for over 20% of total industrial silver demand. In effect, solar energy demand alone has absorbed much of the available liquidity and inventory in the spot silver market. This trend is likely to continue placing pressure on silver inventories for years to come. Against this backdrop, describing the Trump-era policy signals as the final catalyst that pushed the spot silver market into crisis is not an exaggeration. More recently, another factor has added momentum to global silver volatility. China, one of the world's largest silver suppliers, announced that starting January 1, 2026, it would implement stricter oversight measures on silver exports. In reality, the market had already anticipated tighter coordination as early as late 2025. That expectation alone triggered early purchasing and inventory accumulation, which in turn contributed to a second wave of silver short covering, setting off a broad chain reaction. Long-side participants became increasingly confident that short sellers not only lacked physical silver, but would struggle to source any deliverable supply at all. As a result, silver futures markets entered a widespread short squeeze, with rapid and forceful price movements. So where could this powerful rally in silver ultimately lead? Now that we understand the structural forces behind the surge, we can begin to frame that question more clearly. Over the past 50 years, periods in which both gold and silver entered strong bull cycles have occurred only 3 times. The first was in the 1970s, following the US dollar's departure from the gold standard. During that period, gold prices rose by approximately 23 times, while silver surged even more sharply, by nearly 38 times. The second cycle began after the dot-com bubble burst in the early 2000s, and extended through the aftermath of the 2008 global financial crisis. Once again, the core driver was declining confidence in the US dollar, combined with large-scale monetary easing and inflation expectations. That cycle lasted nearly a decade. During that time, gold prices increased by roughly 6-fold, while silver once again outperformed, rising by about 11 times. It was during this cycle that a clear framework emerged. Monetary easing, inflation expectations, and industrial demand conjointly amplified price movements in silver. The third occurrence was in 2020. When the pandemic erupted, the US Federal Reserve announced unlimited money printing, injecting the largest wave of liquidity in human history. At first, capital flows pushed gold prices higher, before spreading into the silver market. Once again, silver significantly outperformed gold. Gold rose by approximately 90%, while silver surged by as much as 150%. As for the current market movement, this marks the 4th cycle now unfolding. And so far, silver continues to run ahead of gold. However, it is precisely during moments like these that we must cut through the fog and the noise, and examine price action from a long-term perspective. When viewed over a sufficiently long horizon, silver's inherent structural weaknesses become increasingly evident. Although in the short term, rapidly expanding silver production is far from easy, the reality is that silver is not as scarce as gold. Within the Earth's crust, over the past 70 years, global gold reserves have grown at an annual rate of only around 1.5%, and have never exceeded 2%. By contrast, the annual growth rate of silver supply has typically ranged between 5% and 10%. Under certain conditions, particularly when the production of other metals increases, the theoretical growth rate of silver reserves could even reach 20%. This clearly indicates that, compared to gold, silver exhibits far more characteristics of a soft monetary asset. In other words, while a surge in silver prices may not immediately translate into a rapid supply expansion in the short run, over a full economic cycle, as long as prices remain sufficiently attractive, significantly increasing silver supply is not particularly difficult. This softness of silver, relative to gold, is also clearly supported by historical data. Since the Great Depression of 1929, the S&P 500 index has risen approximately 8.274 times. Gold prices have increased roughly 250 times. Silver prices, by comparison, have risen only about 150 times. Although during short and medium-term bull cycles, when both gold and silver rise together, silver often outperforms gold. Over the medium to long term, gold remains the harder asset. From this, a broader conclusion can be drawn. The fundamental nature behind price manias never truly changes. In reality, nearly all financial assets, at their core, are forms of expectation-based pricing, not unlike futures contracts. No matter how high prices rise in the short term, they ultimately cannot escape their gravity toward intrinsic value, which is determined by real-world fundamentals such as long-term physical demand curves, a company's ability to generate revenue, technological advantages, and competitive barriers. In the short term, when massive amounts of capital chase a limited supply, prices can indeed be driven extremely high, sometimes even triggering violent short squeezes. But time is always the final force, the factor that strips every financial asset of illusion and pulls it back toward its true value. Emotion-driven speculation and all forms of market noise eventually also return to fundamentals. This is precisely the philosophy Warren Buffett emphasized in his most recent letter to shareholders. If you want to build real wealth, you must be willing to pay a price called patience. You must entrust your capital to businesses and systems that genuinely create value, and allow time to become your ally. Because while financial markets appear to trade the future every single day, what truly survives across cycles and leaves a lasting mark has never been the financial contracts themselves, but what stands behind them. That is the real economy, continuously generating cash flow, building competitive advantages, and forming sustainable value. In the short run, expectations can be hijacked by emotion, inflamed by narratives and stories, but they can never remain detached from reality forever. This is exactly where the complexity of investing lies. What you buy is never a rising price line, but a narrow bridge between reality and expectation. Only when you are willing to stand on that bridge, understanding the true nature of the asset, understanding where its value comes from, and allowing time to filter, eliminate, and crystallize outcomes, can you ultimately stand on the right side. Before we conclude, let me leave you with one of Warren Buffett's classic quotes. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. The philosophy behind this statement is simple. You must detach yourself from short-term price fluctuations in order to clearly see which assets are truly shaping the future and which are merely price illusions. Alright everyone, that's where we'll wrap up today's topic. Thank you for watching and for supporting the channel with a like. See you again in the next episode.